Good morning and welcome to the Killik & Co market update. As the analyst responsible for covering a number of consumer sectors here at Killik, I thought it might be useful to focus in on that area of the economy this week. The consumer is an extremely important component of the overall economy. Consumer spending represents about 60% of GDP here in the UK, and it's a higher number than that in the US at around 70%. So it's important that we spend a significant amount of our time thinking about the overall health of the global consumer, but also how that might influence their future spending habits. Following what now look to be relatively benign years in the decade or so that followed the global financial crisis, consumers have faced a number of challenges in more recent years, including the COVID pandemic, the far-reaching implications of the war in Ukraine, and the return of inflation and rising interest rates. 2023 has so far at least been a mixed year for the consumer sector. At the time of recording, the MSCI World has produced a total return of about 12%, and this is higher than the Consumer Staples Index, but it's short of that of the Consumer Discretionary Index, which has so far produced a total return of close to 20%. This is actually reverse of what happened in 2022, when the Consumer Staples Index outperformed the overall market, and the overall market outperformed the Consumer Discretionary Index. Digging a little deeper into the current sector dynamics, and you find a number of interesting trends at play. The most profound of which is one which has persisted now since 2022, and it's the bifurcation of behaviour between the low-income consumer and the higher-income consumer, with the former pulling back on their spending to a far greater extent than the latter. This is manifesting itself in a variety of ways, but we see it very clearly in the earnings reports of companies and in management commentary. For example, in the most recent earnings season, the European luxury goods sector, which obviously caters to a higher income consumer, had a broadly very positive set of numbers. Whereas in recent weeks, we've seen the two leading dollar store chains in the US, Dollar Tree and Dollar General, downgrade their forecast for the remainder of the year. Elsewhere in sportswear retailing, Foot Locker reported a decline in its comparable store sales for the first quarter of its current financial year. This was in part due to Nike's pullback on the wholesale channel as it continues its direct-to-consumer push. Management also noted mixed performance amongst categories, the most notable of which was weakness in what it calls its lifestyle running category, in contrast to its performance running category, which is a higher price product, which was one area of growth for the business. Other themes are emerging as well, such as signs that consumers are trading down. Off-price retailer TJX has said that it's seeing stores in higher demographic areas producing stronger sales growth than those elsewhere. Dollar General has also noted that they are attracting consumers from higher income brackets. And then there's shrink. Shrink is a retail term for a loss of inventory. This can be for a variety of reasons, but the most common of which is theft. A number of companies that we monitor have spoken about the impact that higher levels of shrink are having on their financial performance. This is a result of the current economic climate we find ourselves in, but also changes to how things such as shoplifting are both prevented and prosecuted. Going forward, we think the prospects for the consumer sector hinge on three main factors. The first is unemployment. The unemployment rate in much of the developed world remains extremely low, and if it can stay that way, it may help to prevent any further decline in the financial health of the consumer. The second is the future path of inflation and interest rates. The US Federal Reserve is set to meet next week to set interest rates, and expectations are that they will pause before resuming rate hikes in the second half of the year. However, having increased interest rates by more than 5 percentage points since March 2022, we are potentially nearing the end of the current rate hike cycle, which will provide a welcome relief to consumers and the consumer sector more broadly. The third factor is China. Many of the companies that we monitor in the consumer space have significant presence in China. The post-COVID economic normalisation in the country is a potential positive for the financial performance of these businesses. However, the country faces its own economic challenges, so it's a region that we will closely monitor in the coming months. Turning to the week ahead, it's the tail end of earnings season now, so it's another quiet week in that regard. We have just Tesco from our covered list who are set to report their first quarter trading statement next Friday. That's everything from me. Have a great weekend, and we'll see you next week.